Hey guys, welcome back to Growth Mode, where we are all a work in progress. In today's video, I want to walk you through a real case study comparing investing in real estate versus investing in the stock market. And I'm a huge fan of real estate, and as you watch more videos, you'll get to know that about me. But one of the primary reasons is that I think it actually gives you a greater advantage to build wealth faster, especially if you don't have a lot of money right now. And you'll see that in this case study. So without further ado, let's dive in. All right, guys. So in this video, I'm going to walk you through a real side-by-side comparison. And this is an example and basically a case study of the first property I ever purchased. This goes all the way back to 2010, but I want to walk you through what I did, how much I invested, what actually happened with the property, and then we'll benchmark that against what if I had done the same thing, taken that money and put it into the stock market. So let's dive in. Basically, I was able to get an FHA loan and put a down payment on a property. And so I put $6,500 of my own money into the deal. And then I purchased a townhome, and that was worth $142,000. So that's our starting numbers here. Put in 6,500 bucks, and now I have an asset worth 142,000. Now, if I had decided, nope, I don't want to buy real estate, I actually want to start investing in the stock market, then I would have taken that same 6,500, I would have put it into the stock market, and that would have been worth $6,500, right? Because in this case, I took on some debt, being the mortgage, and I was able to acquire an asset worth a lot more. However, in the stock market, whether I put that into an index fund or just picked one stock or a couple of stocks, those would be worth $6,500. Okay, so that's our starting point. Now we're going to fast forward 1 year and we'll take a look at that. So I've seen some good averages in terms of the stock market appreciating 7 to 10% a year on average. And then I recently just heard of another number where they went back to 1960 and the internal rate of return was actually about 11%. So I'm going to be generous and we'll use 11%. So if we take 6,500 and we multiply that by 11%, after 1 year, we will have gained $715 basically on our initial investment of 6,500. So now our new value of our stocks, whether it's index funds or one stock, is $7,215. Okay, so let's go to the real estate side. Now we have this asset that's worth $142,000. Now real estate generally appreciates at about 4%, so a lower rate. But because we are going to basically use that on the asset value, because the asset appreciates, we'll multiply that by 4%. And that means that that property will go up about $5,700. So $5,680, and our new value is $147,680. So if we want to look at our initial return here, we will take basically our gain and divide that into our initial investment. And that gets us to 87% on this side. And if we do the same thing over here, there's no surprise, it's going to be 11% because we did that math already. So as you can see, right out of the gates, real estate is dominating the stock market because of that leverage. Again, we used the same amount of money, but we're controlling an asset that's worth a lot more. And even though that asset is growing at a slower pace, 4% versus 11%, we're starting from a much higher number, right? 4% on 142,000 is clearly more. And so we've already got a return of 87%. But let's talk about a couple of other things because we do have some debt associated with this property. So we take this 142,000 and we subtract the 6,500 that we put into the property, and we've got 135,500 in terms of debt, and that's the mortgage. So that's going to be paid off over 30 years in the form of that mortgage payment. Now, every year, some of the principal gets paid off. So that mortgage payment is some principal, some interest. And at the beginning, it's mostly interest. So it's a little bit principal. So it's about 2,400 bucks. I'm just rounding, so don't go fact check me on that, but this is roughly what that first year it paid down is $2,400 in terms of the debt. So at the end of the first year you'll owe about 133,100, somewhere in that region. So that is part of the gain. So we got this on the upside, but then we got this on the downside. So that's the really cool part about real estate, is it's appreciating in value, but over time we're paying down the debt. So you're building equity in the spread there. So if we take this initial gain, add it to the principal pay down, we actually had a total net gain of $8,080. And so our return on that initial 6,500 was more than double, 124%. Now, on this side of the equation, we don't have any debt and we didn't have any principal to pay down. So those numbers all stay the same. So we're looking at 11% versus 124% return in year one. And this is actually how it played out for me on this side of the equation. Now, could I have picked an amazing stock and could it have doubled? Sure. The odds of that are much, much lower. And so we're using average numbers here. And again, we used an average appreciation number on this side, and you're always going to be paying down principal. So this isn't like this is a unicorn scenario here. Yes, I was able to buy something for 142,000. I wish I could buy a lot more properties for 142,000 today. But the principal stays the same. You're going to put a lesser amount down, whether it's 3.5% or 20% if you're buying an investment property, and you're using some amount of leverage. And that is where the power of real estate comes in. So that is year one. About more than 10x better on this side of the coin. But let's forecast it out over more time. So let's go out. I went out 5 years. And so we take that initial 142, and then we go out 1 year to 147. And then eventually 5 years, we get to it being worth about 173,000. So the total gain is 30,000, almost 31,000 on the upside. And that doesn't include principal pay down. And then we take this side and we take that 11%, we run that out over 5 years, and our total gain is 4,159. So at this point, it's been a 64% return over 5 years. So not too shabby, but that 4,000, that's about half of what we got in the first year with the real estate side. And so this just is the gap is widening over time. And again, it's because we've got a bigger number here that is appreciating and compounding over time. So nice return. And then I want to fast forward and just show you how this played out for me over time. So this is about over an 11-year period. Today it's worth about 310,000, 308 to be exact. The total gain on the upside, right? So it started at 142. It's gone up 166,000. So it's more than doubled over an 11-year span. Also, the principal has been paid down 60,500. And then I lived there for a while, but then I eventually started renting it out. And so I've rented it out for maybe about 7 years or so. And over that time frame, it's also produced cash flow. So renters pay me income, and from that income, I pay mortgage, interest, taxes, insurance, repairs, all that good stuff. And then I'm left with my cash flow at the end of the day. And so that is this number. That's after paying all expenses, about 40,000 over that time span. So if we add up the gain on the top side, the principal pay down on the bottom side, plus the cash flow, that has led to $266,100. And if we look at that initial investment again of $6,500, if you could turn 6,500 into more than $250,000, you would do that as many times as you can. Now, of course, we can't all go back and buy properties for 142,000, but historically, if you look at real estate, if you talk to your parents or your grandparents, anyone that's seen generations, a lot of times they're like, yeah, I bought my first house for $30,000. And you're going, what? That's insane. Well, that's going to be the same thing if we fast forward 20 or 30 years out. They're going to go, you got your house for 400 grand? Like, no way. Now they're 2 million. Because with the environment that we have, where we're printing money and there's inflation, even if that inflation isn't astronomical, these values are going to continue to rise over time, just like the stock market. So if we forecasted this out for another 5 or 6 years, it would certainly go past 100% over a 10 or 11 year span. But even if you did pretty well and you were at 200%, 300% over an 11-year span, it doesn't even come close to this 4,000% return on that initial money. So this is exactly why I love real estate and this column. And again, going back to what I said at the beginning, if you don't have a lot of money, this is actually a great way to lever up and get into the game faster and start dealing with bigger numbers. This side, 11% on 6,500, like $715 is $715 that you didn't have to work for. But gosh, that's not super exciting. If you've got 100 grand or $1 million and you're earning 11%, those numbers are more interesting. But to be honest, if you've got this amount of money, like you're going to be able to save a lot faster than you're going to be able to earn. And it's going to take a while for that flywheel to get going. So even if you like the stock market, you might actually use real estate at the beginning, lever up, make some bigger gains, and then take some of those gains and then diversify and put it into the stock market. Or you could just keep going down the real estate path. You might just get hooked. So hopefully this case study helped, and especially in terms of real numbers and a real example. But remember, if you don't have a lot of money, then actually real estate can be a much better way to accelerate your wealth. And a lot of people would argue that if you do have a lot of money, that it's still a great way to accelerate that even faster. All right, guys, if you like this, go ahead and hit the like button, subscribe to the channel so you get more videos like this, and please share it with a friend. I don't have courses to sell. You'll never see me pitching a product or anything like that of my own. I'm just trying to share what I've learned over the years with you in hopes that it helps you in your life and your world. So if you did get some value out of this, the best thing you can do for me is just pass it along, share it with a friend. And as always, we'll see you next time.